All right, so let's get going for today's section. Welcome, everyone. This is our discussion number 76 under the aegis of options for retail investors. We talk about stocks, options, and anything that can make us as a better retail investor. And today, in the same line, we're going to talk about having a good investing mindset. We'll also look at a portfolio risk, what different type of risks appear in a portfolio, and how as an investor we should watch them out for, and how to mitigate those, and of course couple of earnings, etc. And as always, whatever you see here or or you listen to is only for education, so don't go and trade based on solely what you hear in this session. And so starting with the mindset, couple of homework for you all, and we'll get back to this, after some time. Please note it down, 2 questions. Think over it, and I'll also share mine. Now, what's your biggest investing mistake? It could be anything. It could be more to do with, a trade, or it could be a particular stock, or it could be a habit. I don't know, whichever. When you think about your biggest investing mistake, what does that appear to you? And also, what's your biggest investing success? I was listening to a podcast last week where the host was also talking about some of the traits of being an exceptionally successful investor. I'm also going to talk about that a little bit today. But I also want to understand, us as a retail investor, what do you feel was your biggest investing mistake? And of course, your biggest investing success. So think about it. We'll come back to this mindset, and I'll expect some answers so that we can have some more discussion around it. And, see, the best thing is to learn from each other mistakes and you relish in each other's success. So we're going to do that today as well. So think about your biggest investing mistake and success. We'll come back to it in the later part of today's session. Meantime, let's look at some earnings. So how many of you own Disney? This is a familiar name. Everyone knows what Disney does. So I don't have to explain what is Disney. Any Disney shareholders in here? Or if you don't own, just say, no, I don't. Okay. All right. So at least you're able to hear me. I'm a very shy crowd. All right. So Disney, I don't have to explain. Only new additional business that they came up with, apart from the movie studios and the parks, is that Disney Plus. So let's look at what they reported in their latest earnings. Revenue was 15.6 billion. It is down 13% year over year. I don't care much. It is expected that it will be down. Profitability, they blew all the estimates. So expectations was 31 cents. They did way better than what the market was expecting. So both for me are bullish. Let's look at the business units. Disney Plus, which is their streaming platform, it grew almost 9 million to 103.6 million. The expectation was that it will grow 109 million. And this is the reason why Disney shares actually fell down on, after their earnings report, because Wall Street is saying, oh, your growth is now slowing down in Disney Plus. Wall Street they are too greedy, or they have different expectations. It's good to listen to what those talking heads have to say, but then you have to decide for yourself. So growth was less than what the market was expecting. That's why shares were punished. I think it were down 4%, 6%, somewhere around that. Not a big deal. Disney also hiked their price by $1, and their average revenue per user, despite the price hike, fell down from 5.63 to 3.99. Now, this might get someone worried that you increase your price, still your average revenue per user has gone down. What the heck is happening? You know, is it that your user base has not suddenly grown? It means there are some users who are very low cost, giving you very low revenue. So we'll talk about that. Disney parks. Mm, that is really a bad part of the overall report. Revenue was down 44%. Any guesses? Why the revenue this quarter down 44% as compared to previous quarter? The previous quarter, the parks were open in 2020. And now we're just coming out of pandemic. So exactly, yeah, Carmen says restrictions, exactly. So we are now comparing this quarter to the quarter in which the life as it relates to Disney was normal. And as we all know, for almost a year, the life has anything but normal for the other Disney businesses. So parks really black mark on their report. But again, if you think about it, hey, this is what is nothing unusual. So they had an operating loss of 406 million as compared to the operating profit of 756 million same quarter last year. Hulu grew a little bit, not too much. And they also launched Disney Plus Hotstar, a service in India in April 2021. Guidance from their perspective that they had earlier told that by end of 2024, they'll have 230 to 260 million. Disney is still confirming that same guidance. So I don't see in a longer term that Disney has, made any big changes or business has tamed down a little bit. So whatever happened in the stock after earnings, I'm like, okay, these things happen. I don't see any, I don't have any concern on Disney performance in the long term. They are still reaffirming their guidance. So a quick analysis of what I saw. Now with the CDC guidelines that they provided on Thursday around the new mask guidance, in which you don't have to wear the mask. If you're fully vaccinated, that should bode well for parks. Imagine, asking tourists to put on mask in Florida. What it is on Florida, what, 85, 90? This now also with the vaccinations, rate of vaccination improving, more and more people getting vaccinated, economy reopening, this should do well for parks. Second thing, average revenue per user declined because they also launched a Disney Plus Hotstar in April in India, in which the average price of the service will be way less than what we have in United States. So that's the reason why the average revenue per user have gone down, because there are more, they also got additional users which are paying much lesser than what they are charging in United States. And lastly, this quarter result was compared with the pre-pandemic result of a previous year. So it's like we are now comparing when the economy was all open. From a Disney perspective, everything was good, to now where they still have restrictions. So subsequent ones, we should see an uptick in their park revenue because of restrictions being removed. And from a park perspective, from a movie studio perspective, the coming quarters should do good. So even the, whatever slowdown we have seen in Disney Plus, which is their streaming service, should get compensated a bit by the parks and the studio revenues. So I'm not concerned that Wall Street punished Disney because they saw Disney Plus subscriber growth not as much as they were expecting. So I'm still bullish on this one. We talked about it earlier. I think this is a kind of an all season stock to own. Sometimes I feel it's all season and all ages stock to own. My kids would love to own Disney, and so would I. If there are restrictions, they got a Disney Plus streaming service. Economy is reopening, they got a movie studios, they got a parks. So I think probably a good stock to own. Again, from an education opinion only. It's not a recommendation. I don't work for Disney. But I think it's a decent stock to own for long term. Any questions on Disney? Some of you said that you own Disney, and some of them, I think Ramesh said that he has options too. Hopefully you haven't sold off on the when Disney went down 4%, 6%. Stocks will go up and down. But I want to focus on where the business is going and not where the stock is going in short term. I don't see any reason of, around the business. I'm not concerned on the business front. So why should I sell the stock? Okay, Ramesh, I did call last week. Vijay says just bought small after the dip. Yeah. Again, don't get too big. That's my number one lesson, which I have learned as an investor is don't get too big on any position. So if you bought, great. Make sure the overall position is still under the position size guidelines. Let's look at the next one, Unity. Not a household name, not as household name as Disney, and probably I see some new names. So maybe not all of you would know it, but so let me explain. Unity. Unity is a leading platform for creating 3D, real-time 3D content. Now, it's best known for the platform behind many of the 3D games. So there are two big players in 3D games, in the platform that allow the developers to create a 3D games. One is Unity. The other one is Unreal Engine, which is from Epic Games. So Unreal Engine is used by the Epic Games, which is a creator of Fortnite, which is now battling with Apple for against their App Store monopoly. And the other one, which is being used by most the out developers not who don't use Unreal is Unity. They have tools for all the creators. Now, from a gaming, they're also now venturing into a lot of other areas. So again, I would say this ad nauseum. The next social media platform is going to be a gaming platform. It's just a matter of time before we start meeting inside a game, inside a 3D, I would say, virtual world. Maybe we'll replace Zoom and meet inside a conference hall in a 3D virtual world. That day will come soon. So as more and more interactions will move towards games or inside the 3D virtual world, these platforms will become super, super important. So again, my thesis on Unity is 5 years, 10 years down the line, this should be the one like everyone have to use it. every developer have to use to create uh, those environments, those metaverses. So they came up with their recent results. It's also a recent IPO. From a results perspective, revenue up 41%. That's good. We like when the revenue is up. Loss from operations was 110, close to 111 million as compared to 27.4 million last quarter. Not a good thing. But if you look at why this happened more, why the margins were down, because they went IPO. And this is not with just with Unity. I was also looking at another company that was also recent IPO. And now I have to dig down deeper on when these companies go IPO, they incur some of the paper losses, they become real losses because based on stock-based compensation. Because a lot of these RSUs and stuff like starts to vest. I don't know how the exactly detail works. Anyone in working in a finance department probably can explain better, but that's something I need to understand a little bit more, because now I'm noticing on some of the companies that have gone recently IPO, their operating margins have come down. And one of the big reason is, of course, the IPO cost, the cost of going IPO plus the stock-based compensation. Again, this is not related to a real business. So I'm okay. This won't be a recurring expense. So not too much concern that the margins have gone down. They got three business units, create solutions, in which they provide tools for developers to create those 3D games, operate solutions. Those are the, again, I'm not going to get into the details of it. We talked about Unity when we did a whole deep dive into Unity as a company. If you want to go back, you can refer that. Operate solutions where they provide tools to those developers to run their businesses better. And third business unit is their strategic partnerships in other revenue segments, which is now growing, at really well. Customer growth, impressive. Now they have 837 customers, each generating $100,000 of revenue as compared to 668 last year. I see a question. What is the ticker symbol for Unity? It is very complicated. Just U. Just a symbol U. The next one, another metric which we want to focus on is the dollar-based net expansion rate. Means the customers who were there with them, and they spent $100 last year, how much are they spent in this quarter? So now, as compared to last year, this quarter they have spent $140. So that's what called dollar-based net expansion rate is. The same customer, are they expanding their engagement with Unity or not? It means they don't, even if they don't acquire new customers, the existing customers, they themselves have given them 40%. They're spending 40% more. Of course, they will also have, they are probably also have some customers who have churned, who have left Unity. But those who they still retain, they have 140%. They raised their 2021 outlook to $1 billion. So the market had little concerns with Unity, saying now the restrictions opening up, people want to go back to their normal lives. Of course, you had a tailwind because of COVID restrictions. Everyone wanted to play games, developer wanted to develop games, and hence you had a tailwind. Unity came back and told, you know what, we are raising our guidance, our revenue outlook to $1 billion. So again, I'm still bullish on this, irrespective of what the stock is and where the stock is. I think again, a good company. uh, to look at it from a long-term perspective. Till now, we only looked at games. Now let's look at what else is also happening. Few other updates. There's a company King, which is the maker of Candy Crush games. I'm not a big gamer, so I have no affinity for Candy Crush or for any other games, but I know that this is a very famous game. I've heard these names. Candy Crush released its first 3D mobile title, which was built on Unity platform. Outside of uh, gaming, they continue to get a new business. Now they have a new customers in household appliances, which is Lowe's. There, the Lowe's and the Home Depot. That Lowe's. So it's a customer of Unity. They got a customer in automotive segment. They got a customer in healthcare segment. Most of the thesis current thesis and the valuation is based on what Unity is doing in a gaming sector and how strong they are. But now they are expanding a lot on outside of gaming sector. There are customers in aerospace, government, as well as retailers. Unity and Hair Technologies, they are collaborating to create a next generation of in-car experience. Now they're getting inside your cars. I don't know, what exactly they are building. Probably the whole interface in our cars, instead of having a 2D plain interface, maybe they're building a 3D interface for cars of the future. And these areas are what are options which Unity has. For any business, any great businesses, one of a very important thing is that they need to have an optionality in your business. Otherwise, the current business, if you are in, it is profitable, competitors will come in. You will be challenged. So the best businesses that have done great for shareholders will always have optionality. The king of optionality is Amazon. Started with just books. Their overall market was Barnes and Nobles or Borders. If they would have stayed only on books. Now look at what Amazon has done from an optionality perspective. They're looking at every other sector. I mean, that's why the stock has done great over a long period of time. So I like that the management of Unity is not just resting on its laurels on, yeah, we own, we are great in this gaming space, but they are also focused on these areas, which probably right now they may be eating up uh, the dollars, not contributing to the margins. These are the ones which are in investing mode businesses, but could provide great optionality in future. Any thoughts on Unity? Anyone owns Unity? Any owners of Unity here? Okay. All right, third one. Again, this we talked about it did a deep dive of it. I think Jumia, whenever they report result, I talk about it. Okay, I see. No. Steve says nothing over there on Unity. Vijay says yes, he owns Unity. So again, if you don't have any exposure to this sector, look at it. Stock may be expensive right now. So I don't know where it is. Should be around. It had gone. Let me just bring Unity stock. Like all the new IPOs and new tech IPOs, Unity had its own great stock run up, and yeah, now correcting back to where it was close to IPO. like many other stocks. But I'm not concerned about what's happening to Unity in next few months. I want to look at what's Unity doing in terms of its business, and do I like their business, and do I like that they have a growth? And what I see, yeah, I like it. So I'll continue to be in Unity. It's trading at 87.48. Oh, yeah, 87.48. So again, stock short term can do anything, can move wherever based on what those Wall Street institutional investors or the big fund managers have eaten in their breakfast. So we don't have to be worried about that. Third one, and the last one from analysis perspective, again, we did a deep dive of this company somewhere in mid of November. It's been a great performer since then, despite the fact that it has fallen down the cliff from its all-time high of, I think, close to 60. That's okay. We talked about it when it was around 14, 15. So still pretty good from a position perspective. Steve says Unity has some pretty juicy premium. Yeah, true. Their IV is higher. You can get some nice premium. Let me just look at what's the premium at the money premium. So 18th June. Yeah, you get close to 5%. 5% premium for at the money. And go to another 3 months, 97 days, close to 9% premium. Yeah, so definitely very decent, juicy premium in that. Ramesh says November is 6. Not sure what does that mean. Okay, Jumia, Jumia Technologies, also known as Amazon of Africa. I mean, it is for us. It is very easy if you can put these monikers on the companies that this is Amazon of X or Netflix of Y or Google of Z, Z. So Jumia is termed as Amazon of X. It's an e-commerce retailer. It operates mostly in countries in Africa, and unlike in US or in developed countries, there is almost no infrastructure of base infrastructure which is needed for e-commerce in Africa. So this is like very, very, very early play on Africa. Again, we did a deep dive in November, spent half an hour to figure out what's my thesis on Jumia, and was bullish on it. And stock has done well. It's fallen down, but still almost 100% up from when we reviewed it. So let's look at it right now. From revenue, only 27.4 euros. They report revenues at all the numbers in euro. It is called Amazon Africa. Its head office is in Germany. So it's got a little weird, I would say not weird, but uncommon corporate structure. The company is based out of Germany, but the whole operations, the business that they are focused on is in Africa. So that's why they report numbers in euro. So revenue declined 6%. For an e-commerce company, decline in revenue, not a good scene. We want to see a growth in the company. The reason that Amazon was always richly valued was because of the growth. And now we're looking at a Jumia in which the revenue has dropped. So there are concerns. Yeah, I have a little concern on that. Profitability is actually increasing, which is again different than how we have seen Amazon growing. When Amazon was growing, The traditional value investors, their jaws were dropping on how come a company that is not even making money, instead they are losing money hand over fist, and stock market is giving them such a high valuation. It's all the play on the growth. And now I'm looking at Jumia is actually the other way around. They are doing better on the profitability front, on the margins front, at the expense of revenue. Their customer growth, they had a little customer growth, 7% year on year, which is good. Order growth also increased. The number of orders that the customers placed on Jumia platform also increased to 6.6 million. Gross merchandise value, which decreased, it was around 665 million. It's a 13% decrease, which directly impacted on their revenue. So GMV is what's the total the value of the goods that were sold on Jumia platform. The revenue is how much did they earn? What was their cut-off share? How much revenue did they earn out of all the sale? So what's the reason? Why is this e-commerce company actually taken a route which is different than what we have seen other e-commerce companies taken? We have seen Amazon, we've seen Mercado Libre, C Limited. They all focused on one way, which is increase revenue, don't worry about profitability. On the other hand, Jumia told us last quarter, not 2 quarters earlier, that they will not be going for revenue at any price strategy. They want to focus on growing the company profitably. I'm not saying there's anything bad in it. Depends on what type of investor you are. You may have to now decide, your association with Jumia. So company used to sell high price items on their platform, TVs, electronics, cell phones. Cell phones used to be the biggest driver of revenue for Jumia. Now they changed the strategy. They said not everyone wants cell phone, every week. So the products that they used to sell earlier were high price, but lower margin and less recurring expenses. You don't need TV every month. You don't change cell phones every 2 months. In US, we change it every year, not in countries like Africa and all. So they wanted to move the business model from those one-time high-value purchases to everyday purchases, things that customers will purchase again and again and again. So that means while they're going through this transition, we will see a decline in revenue because these everyday purchases, toothpastes, all household items, diapers, paper towels, or any of these things that we need in our household, those are not high value items. Those are low value items. And now Jumia is focused on becoming a marketplace. So it means they don't have their own expense. Amazon is growing their marketplace. So Jumia is focused more on their marketplace business, in which they will derive more and more revenue from the other third-party sellers. So Jumia is like, I'm a marketplace, you come and sell it here, I'm gonna take a transaction, commissions or cut from your transactions. So while this transition is going on, that's where we are seeing that the revenue is declining. So they're no longer focused on selling more expensive electronic items. They are more focused on growing the revenue from everyday products. So now you have to decide what was your original thesis of Jumia based on why you invested. And now the company has pivoted. They have changed their business model. Do you align your investment thesis with that? Great. If not, maybe take some action. I took some action. My thesis was that it will grow crazy like Amazon. Now they decided not to. I was like, okay, I will tone down my bullishness on this. Now this will become much longer game. Eventually, this might be a right way to grow. Who knows? Again, company has changed their business model, so I will change and relook at my thesis on what to do with this company. There are other business, Jumia Pay. This is which I am bullish on. Again, the same. I think Amazon hasn't done a great work in this aspect. Mercado Libre has done an amazing work in promoting the usage of their payment platform. But Jumia is doing this, which is good. The transactions grew 6.7%. Total payment volume grew 21%. Now, if I see if this really become a good platform and its usage grows within their marketplace, what if they take up the same strategy what Mercado Libre has done? That Jumia Pay could be used on platforms outside of Jumia. Oh, that would be great. So, optionality. If their e-commerce doesn't work, they got an optionality to grow Jumia Pay just as a separate payment business, just like Mercado Libre have done. We have an example. Amazon has not done a good job over there. We don't use Amazon Pay much. I don't use Amazon Pay on Amazon. Forget about it at the other retailers. But Mercado Libre, their what's their payment? I'm blanking out on their payment platform. Margo Pay? Forgot. Anyway, so they have their own payment platform. Now there are many retailers which use Mercado's payment platform. It has nothing to do with the any sales of from a Mercado Libre as an e-commerce company. So that brings optionality. So I like that optionality of Jumia. Very volatile stock. It was at $14 something in November, open positions, went all the way to 60, went down to 22. I don't know. It's right now, it's around 25, 28, 30, around that. So it's a very volatile, and that's why Steve, it's got a high IV. Its IV is generally up more than 100%. And it also has a decent premium because of that. Balance sheet, nice balance sheet. But Jumia has been one thing which I don't, I would say, like on Jumia is I feel they are moving too fast into a lot of other categories. They also have a Jumia food, Jumia Eats. I think that's what called. It's like Uber Eats. And I'm like, focus on your e-commerce and payment. And don't try to do every business what every other successful business in the United States is doing. So they opened, they got big into Jumia Eats during the pandemic. My bigger question is that gonna take away the focus of management? And they still need a lot of money and focus to grow their e-commerce and Jumia Pay. But we'll see. The flip side could be, hey, they got an optionality. And if they could do good, like Uber Eats is bringing more money to them than the Uber rides. So we'll see. So that was around Jumia and its earnings. Okay. Oh, you're welcome, Rasif. Any other questions on Jumia? All right, next what caught my eye was a tweet from Jim Cramer. And I was like, forget about us trying to figure out what will happen to the stocks in short term. Even the experts. He's been an ex-hedge fund manager. Jim Cramer is a CNBC host for, I think, a few decades now. I don't know, maybe 18, 20 years. Is Mad Money has been doling out investment advice for decades. So recent tweet from him on 14th, yesterday. I have been heavily criticized for my Coinbase position. I urged people not to pay more than 370s. Not listen to. Oh, but this was a very good question. Maybe a caller called in and would have told on Jim Cramer on Coinbase, he says, why did you pay more than 370? And then someone actually put out this tweet a month earlier from same Mr. Kramer and said, get Coinbase to 475. Again, the fact is nobody knows what stocks will do in short term. I would rather have him say bullish on Coinbase because of these businesses and not talk about Coinbase go to 475 or where the Coinbase would go to wherever it is, where it is now. 258. We never know. That is why I always focus on don't think that we know where the stocks will go. Always have room for error. That is why I like options, is I get a room for error. I don't have to pin a stock price to make money. Give you room for error so that even if you are wrong, I shouldn't say even if you're wrong, most of the time they will turn out to be wrong. It's a very few stocks which goes in our thesis. And that's where we'll talk about it and an investor mindset on most of the money that any of these big funds will make is on a limited number of stocks, very few stocks. Most of the time, stock market will do different or opposite of what we expect. So have a room for error. Don't put a line in the sand saying, okay, this is the price now. My portfolio is positioned based on Coinbase is above 300 or not. Have ways in which if Coinbase falls down by 5-10%, you're okay. Or have means so that if Coinbase falls down, you can still keep reducing your cost basis. So it's even a way below there where it opened on IPO. And this is happening despite the fact that what we are seeing in the cryptos, all the crypto, the transactions, they are through the roof. Look at Square reported what 11 times transactions as compared to the last year on the crypto side. PayPal reporting so many. They are enjoying the tailwinds from crypto, and now this company is 100% crypto. Well, the valuations were absurd. I see a question. If Bitcoin goes to 100K, then coin where? I don't know where the coin would be. But again, the whole thesis is, so let me put it this way. Coin does not depend on the Bitcoin prices. I know I'm making a controversial statement, so hear me out. This, you might hear, different from someone else. You might hear things differently. Coinbase valuation will be based on how many users are interested in transactions. They don't hold Bitcoin on their balance sheet. Oh, I would be concerned if they hold Bitcoin on their balance sheet, because the rest of the business is anyway dependent on the interest in crypto. So if Bitcoin goes to 100K and the people still, that makes more and more people transact in Bitcoin or transact in the general crypto economy, it will do good for Coinbase. They make money from transaction volume. If Bitcoin goes to 30K, but there are Dogecoins on the safe moons, and those are the ones which are seeing a lot more transaction volume, then that will do good for Coinbase. Hopefully, if they list those coins. Which reminds me that when it comes to money, there are hardly any ethics or a principles that a company will stick to. Coinbase used to pride themselves on the um, the strict criteria that they run any of these crypto assets through before they list. So they didn't have a Dogecoin on their platform. Now they're seeing everyone making, all the exchanges making money on Dogecoin. They're like, we're gonna list the Dogecoin. Dogecoin will be on Coinbase soon. I'm like, come on. There where you see money, you forget about all the principles that you had laid down on why Coinbase is different, why their selection criteria is different, and they want to protect users. At the end of the day, they don't want to lose the transaction revenue from Dogecoin to other exchanges. Yeah. So if Bitcoin goes to 100 and that keeps a lot of users engaged, I think yeah, Coinbase will go high. Now where it will go, nobody knows. That is why I don't even just provide numbers. Some people will give a number, it will go to 400, 500. On what basis are we saying this? So, but it will do good from the business perspective. So not getting into the details of crypto, we'll do it on Thursday. Just an overview perspective. On the leaderboard, Doge is still here at 50 cents. Thanks to Elon Musk. We see a lot of movement in Cardano, is now slowly rising. It's above $2 for the first time in its lifetime, I guess. And from the leaders, Bitcoin, Ethereum, no other change. That's all on the earnings. And let's jump to the next topic of portfolio risks and mitigations. Like I mentioned earlier, today is going to be a lot more food for thought, a lot more, I would say, content around managing investment. Not going to look at a very specific, I mean, I haven't prepared any content very specific to, let's look at certain charts, etc., or stocks and how they are doing. If you have a question, maybe you please throw it, after I'm done with some of this content, or put it in the chat. If I follow that company, I'll probably answer them. If I don't, yeah, I'll put it on my list to follow that company. But today we'll focus a lot more around becoming better investor, irrespective of what the stock is. So next, we want to talk about portfolio risks. What type of risks exist in a portfolio? There are multiple types. And how do we mitigate them? Before that, any other question? Otherwise, we jump into portfolio risks. And then we'll come back to, we'll look at an option trades. And then the last one, we'll go back to our mindset. So remember those two questions. What is your biggest investing success? And what's your biggest investing mistake? Please note down the answer, write it down. And we'll talk about it. Oops. All right. So let's talk about portfolio and what the different types of risks, and how do we as an investor mitigate those risks. So whether you are a retail investor, which I assume most of us are, or even if you are a hedge fund manager, I don't know, anyone in this meeting who actually manages funds? Anyone in here who manages money on behalf of other people? Okay. Is everyone here manages their own money? Steve says, I do good to manage my own. Oh, that's all we want. As long as I can manage my own money. Yeah. So most of us are retail investors, let me put it that way. who manage their own money and not money for anyone else's money. But irrespective of whether you're a retail investor or you're a hedge fund manager, whether you have a small account size or you have $1 million account size, I think every investor need to understand what are the risks in the portfolio to survive and thrive in any type of market condition. So these are a few type of portfolio risks. Directional, we'll get into the details. Directional risk, correlation risk, leverage risk, tail risk, sequencing risk. Let's look at a directional risk first. As the name suggests, this is the risk of stock market moving. And then how much is my portfolio moving with it? Let's say stock market goes down. And when I say stock market, take an example of an index, right? SPY or QQQ, depending on what type of portfolio you have. If you're well diversified, which is closer to SPY, so let's talk about SPY. If you're QQQ, if you're all owning techs, which we should not, but let's say if it is closer to QQQ, then how much directional risk do you hold? Means if QQQ or SPY moves down, how much does your portfolio move down? If it moves by $1, how much your portfolio moves? So in this example, portfolio A, both portfolio size is 1,000. But if market moves by $1, portfolio A moves by $200. Market moves by $1, portfolio B moves by $100 only. Which one do you think has got a bigger directional risk? Yeah, please put it in the chat. Is it A or is it B? Which one has got more risk in their portfolio? More directional risk? Correct. It is A. And most of the retail investors probably only focus on the directional risk. And to mitigate it, you have to reduce in terms of how much your portfolio could move. Which is, how do you do that? You look at what's called portfolio beta weighted delta. I'm not going to get into the details of this. This itself will need another 15 minutes to explain what portfolio beta weighted delta is. But if you're using Think or Swim platform, without getting into the details, you can create and know what's your portfolio beta weighted delta is. So if you have a tech, you just put QQQ here. On check on beta weighting, it will tell you. If you have SPY, put a SPY here and it will tell you. There is no perfect number for it. But understand what the number, what's your portfolio beta weighted delta is. So now, for example, in this case, in this sample, if a QQQ and this delta, this is beta weighted delta because the beta weighting is checked, is 24 close to 2350. What does that mean? That means if QQQ moves up by $1, this overall portfolio is expected to move up by $1. If QQQ goes down by $1, this portfolio, the portfolio will move up by 2350. If QQQ goes down by $1, this portfolio will go down by 2350, 2365. If QQQ goes up by $5, this portfolio will gain close to 10,000 in a value. If it goes down by $5, it'll move 2365 multiplied by 5. Now, higher this value is, higher is the risk and reward. So one way to mitigate this is to keep reducing this number. Most of these big, or say, these market maker firms, which keep spending money, things like citadels, those market makers, they all operate at delta being close to 0 because they don't want to take any directional risk. Ken Griffin, CEO of Citadel Securities, was pulled in front of a Congress during this whole GameStop. They are market makers. They are not in a business of determining where the stock will go to profit from them. That's why when someone asks me that I am selling if market maker is buying it, am I doing a mistake? Is market maker bullish on it? No. Market makers tend to stay close to 0 delta. So you reduce even without reducing your portfolio size, you could still reduce your deltas on it. Use options. We'll talk about it when I don't know the session number, but in the boot camp, when we'll talk about it, delta hedging. That's called delta hedging your portfolio. So I'm not going to get into details of this. That's what the option boot camp is for, where we get into the details of how to use options to hedge your portfolio. That is what it's called delta hedging. Reduce your delta. This will reduce the directional risk. Next one is correlation risk. Correlation defines how one ticker moves with respect to another one. So for example, these are some of the ETFs: SPY, QQQ, IWM, TLT, bonds, GDX, gold miners, gold miner junior, oil ETF, another oil ETF. Now, correlation tells us generally how the tickers are related to each other in terms of movement. And we will see, if you look at this SPY and QQQ, correlation is 0.8. And this is a little bit of a math. Now we've gone back to high school. It means they move very tightly with each other. 80% correlation. If SPY moves by 1, maybe QQQ will move 80% of the time. It will be moving in the same direction. Whereas the bonds probably move in other direction. Not too tightly, but it does move in other direction. Whereas GDXJ and GDX, both are gold miners. They move like 1:1. Again, the idea is, if you have in your portfolio, if you have very highly correlated tickers, then the portfolio is subject to what's called a correlation risk. Is if SPY goes down, so is QQQ, so is generally IWM, and then suddenly your portfolio, you'll see a lot more impact on your portfolio. How to avoid this is diversify your portfolio. So go back and look at this is OIH, which is oil, and the tech. They're not tightly correlated. Oil and the bonds are not tightly correlated. So pick up the tickers which are not always tightly correlated. This is what, when we talk about diversification, that's a basic principle behind it, is to avoid the correlation risk. Don't hold all tech, all energy, or all metals in the portfolio. If that was the case, then we have had a huge trouble since February if we all are too big in tech. Now, what has worked this year is energy and financials. Tech hasn't worked. What worked last year was tech. Energy didn't work at all. Financials didn't work at all. So if in 2020 we were all loaded up on energy stocks or financials, bad. So we don't know when these things, which becomes too popular in what particular cycle. So the best is to avoid this correlation risk, have a well diversified portfolio. Any questions in now? It could be, okay, let me know. Let me do a pulse check. Is it you're able to carry, or is it too heavy a content? And most of the retail investors, we only look at the direction side, but I think we should be looking at all these types of risks. And that's why I want to share. If it's too heavy, I will try to explain it a little more layman's language. Still okay? Everyone's still doing okay? Haven't gone to sleep? Okay. All right. Still, shall I continue on this one? Remember I said it's heavy. Can I explain a little bit more on this one? So, so I don't know which one you were referring to. Correlation risk, or if you're talking about the delta, we'll talk about it in option boot camp. It's a huge concept around delta. Leverage risk, and leverage risk is something which will not apply to cash accounts, which is what if you don't have options enabled, then on the stock side you generally have a cash account. I don't know, maybe in a margin, I'm not sure. Let me put it that way. But if you have a cash only account, then leverage does not apply. Okay, let me just look at some questions. How to read and react. So from a portfolio, a delta, the platform just tells you what your portfolio beta weighted delta is. So for example, in this case, the case that I looked at, this sample. Right? Now, if I look at this sample and I'm looking at QQQ is what, 2365. Now, my first reaction here would be, hey, I think this is too big. I'm too dependent on QQQ. And now I know that the tech market sector is not doing good. I need to reduce the deltas in QQQ, means my portfolio deltas. So there are ways. Number one is, if there are tech stocks that I have, maybe I could sell some of them, or I could sell calls on them. Right? There are ways to reduce deltas. Or I could just short QQQ. Oh, I've done that sometimes. Is I can't figure out, I can't sell calls because maybe I don't own 100 shares and I don't want to sell a call spread because not much of a premium. If I go and sell 100 QQQ short, this will reduce my delta by 100. So there are ways, and then you can react based on how you want to reduce the delta. Based on your portfolio value, overall portfolio value, you will find a zone wherein I want to keep it maybe around overall delta to be 1 to 2% or 3% or 4% of my overall portfolio value. If it goes higher than that, I want to reduce it. Then you use the means of reducing it by either shorting or selling calls, or buying puts. I don't suggest it, but that's also buying put is also a way to reduce delta. What's the other one? Is normally we hedge with options to reduce market risk. Yes, buying a put is a way to reduce delta. Selling a call is a way to reduce delta. Selling a stock short is a way to reduce delta, directional risk. All these are the ways to reduce the overall delta in a portfolio. More details in bootcamp portfolio hedging discussion. Correlation by a well diversified. The tickers that you hold in your portfolio should be well diversified. Not all oil, not all metals, not all tech, not all insurance, not all financials. Allocate. So before I became active as an investor, I used to only have 7 ETFs because I had no time to look at individual stocks. So I only owned ETFs. And then I owned 7 ETFs, just from a diversification perspective. Next one is leverage risk. It applies to margin accounts. When you're having options, you enable options on your account. By default, you'll get margin if it's more than $25,000. It's a great thing. Despite what we hear in financial media, it says margin is curse. Retail investors shouldn't have margin. I would say retail investors should have access to margin, but we should learn how to use that margin. It's a great tool. Just learn how to use it well. Because it can cut both ways. In great times, leverage will amplify the gains, but in bad times, it also amplifies the losses. The best is to know how to use leverage and how much to use. Anyone remember the recent example we talked about in maybe a few weeks ago? The recent turmoil in stock market that was caused by an ex hedge fund manager now managing family office. Anyone remembers that? That was all because of leverage. Archegos Capital, super duper heavily leveraged trades, 20x times leverage. What great! Made tons of money on Viacom CBS when it went up. The moment it started dropping down, got wiped off. So, Kate, I know some of many of you probably trade options. And if you're selling options, this is the thing that we have to be always aware of in terms of a leverage risk. Now, how to mitigate it? Keep your dry powder on the side. Don't always consume whatever the power that your brokerage firms gives you. Say you have brought in cash of $50,000. And if you're buying stocks, brokerage will tell you can buy stocks worth $100,000 because mostly the stock is at 50% margin. So if you bring in $50,000 in your brokerage firm, then you could still go ahead and buy stocks worth $100,000. Don't do that. Don't go ahead and buy $100,000 worth of stock. Maybe buy $60,000. Not more than that. 70,000, not more than that. Always keep the dry powder on the side. If you're heavily leveraged, and some of traders would have been, some of the hedge funds would have been when March 23rd, 2020, they would have been out of business. So keep a dry powder on the side. Don't over allocate. Means don't use all the buying power that your brokerage firm provides. They will entice you. You will still feel, come on, I have so much of a power available to me. It's like your credit limit, equivalent of credit limit on a car. You're like, I still have so much of a limit available to me. And so why don't I go and invest it? Market is doing great. I'll be able to get some returns. Otherwise, it's just sitting there. Especially if you are selling options, don't go beyond, don't consume more than 50% of your buying power. If you stay within that, you'll survive any of these ups and downs in the market. You'll survive getting those margin calls. That's the worst thing to happen. When broker will give you margin call and they'll sell the stocks on your behalf. We don't want them to do it. So stay at a portfolio level. Don't consume everything which is offered to you. Same as the concept. Don't use your full credit limit on your credit cards. Next one is tail risk. So before we get into the tail risk, let's first even understand what does that mean. Going back to high school, we used to learn about this graph which is called normal distribution, which tells that mostly things in life are not extremes. If I'm going to office, I know typically what a time it will take for me to reach office. It's not exactly the same every day. But if I keep noting the time it takes me to go to office every day, keep track of it, and then I plot it in a graph, it will actually come out to be like this. Most of the things are normally distributed in life, in stocks as well. So for example, this is the distribution of birth weight, normal distribution. Who says kids can, these things are random, but still they're normally distributed. SAT scores in 2020, perfect normal distribution. Temperatures, if you look at for every decade, if you look at say 2001 to 2011, still this graph looks like a normal distribution. Decade previous, this blue, again normal distribution. S&P 500 returns from 30th December to 6th Jan 2020. Not perfect, close to normal distribution. This is an exchange in India. Daily returns, normal distribution. So these things appear in wherever we have a lot more occurrences. We'll see that things are generally not at extremes. Height of 14-year-old girls. Now we come to, I picked up this one on from 14th May to 2021 to, yes, till yesterday, daily returns on S&P, SPY, this QQQ. If you plot it here, looks like a normal returns. So many of these strategies, option strategies, are based on the fact that the returns, stock movements happen in a normal distribution fashion. So, but does that mean that a stock will not go far low or will not decline too much or will not increase too much? No, that's what called as a tail risk. even though over years, they generally stay in this range bound. There are some occasions which are tail risk, which is, for example, it happened here in QQQ on one particular day instance. It was down like 6%. SPY was down 6% on one particular instance on one day. QQQ, two times in this 365 days, it was down close to 5%. These movements which happen once in a while, outlier movements, are called tail risk. If you look at these are called the tails. This is supposed to be very thin. There shouldn't be anything under these. But we have seen sometimes stocks will make a huge moves. And would have heard on CNBC, this is 1 in 100,000 chance. But this could happen. And God forbid if everything I was holding was QQQ, that would have been devastating for me. A way to avoid is to stay small. Don't go too big on any position. Position size, 5%. Beyond 5%, I start to become a little more cautious on why this position, my cost which I've invested in is, why it is more than 5%. It could grow to higher, that's fine. But otherwise, one of these tail risks. Google is a great company. Amazon is a great company. But I don't know when one of these events could happen. People say ETFs are all safe. But we have seen QQQ moving 5%, 6% in a day. So stay small. Don't hold 2 or 3 stocks in your portfolio. Hold at least 25, minimum 20. That means no one position is more than 5%. So even if one of them goes down, you're still okay. And then if you're well diversified, then QQQ goes down, so all techs go down. But if you also have oil, you also have others, still be okay. And if things like March 23rd happen when everything falls down, then what saves you is your dry powder on the side. We'll talk about leverage. Okay, I still have cash. I'm still okay. I'm still alive. I'm not getting margin calls. I haven't gone too big earlier. So that's a tail risk, is stay small in any one particular ticker. Okay, so question, is there a way in TOS to determine what a sector a company stock is in? You go to fundamentals. In the TOS, there is a tab called fundamentals that might tell you which sector it is in. I mean, I generally know, so I haven't really tried to look at the stock. VA says based on risk tolerance, time horizon, you may use portfolio mix with stocks, bonds, cash. Exactly. That's what stay diversified. Have a mixture of bonds, have a mixture of stocks. Within stocks, have your growth stocks, have value stocks. If you had only had a growth stocks, great 2020. You don't want to open your brokerage platform in 2021. Portfolio construction tools are offered by most brokerage firms. I think most brokerage firms show what your current portfolio is. I think also some of them actually, if you give a questionnaire, they fill up a questionnaire, they'll tell you this is how you should construct your portfolio. Ramesh says leverage, but don't overdo it and never get into margin call situation. Exactly. Don't you have to check the holding in ETF? You could be buying multiple stock in the same ETFs without knowing. Yes, but when you're looking at an ETF, for example, that's where your correlation comes in. Now, I don't want to be picking up GDXJ and GDXJ because those will be both are gold miners. They will be picking the same stocks because both are tightly correlated. I don't want to be picking up SPY and QQQ from a diversification perspective, tightly correlated. So that's where if you look at a correlation of one ETF to another, you'll get an idea of how tightly they are correlated. Of course, you can go to their individual holdings also, but at the end of a day, it's a correlation that will tell you how one ETF moves as compared to another one. How they move in tandem, let me put it that way. How tightly they move in tandem. So if you look at a correlation, that will give you that information. So mitigation for tail risk is still small in the trade-off because these numbers play out. All the stats that we learned in high school play out only if you do more instances. So where we looked at an average SAT score, if I'd only picked 50, you wouldn't see that normal distribution. But if I pick up 50,000, that's where it lands up in. So that's why, especially on options, I focus on trading often. I want to be involved every month expiration period so that I give time for probabilities to work out. Instead of me doing going and selling an option 4 months out, I would rather sell 4 options 1 month out. So I don't know when the markets could move. So that brings me to the next one, which is our sequencing risk. So selling option options is a probabilistic method. There's a method behind it. It's not randomly, that I've decided on one day, okay, I'm going to sell options and pick up. So the pattern which I'm building, a system which I'm working is there's a method behind it. It is based on probability. And probability will only work if you let it work. If you don't give it in next, do it something for next 2 months and you say, oh, it didn't work out. It's like, I'm telling you, if you flip a coin, 50% of the time you'll get a head, 50% of the time you'll generally get tails. It's a 50-50 chance. You flip a coin 4 times and say, oh, I've got 4 heads. Doesn't work. I'm out. Yeah, but if you flip it 100 times, you'll get closer to 40-50. If you flip it 1,000 times, you'll get closer to 47-53. Flip it 10,000 times, you'll get very close to maybe 49.5 and 50.5. That's how the probability always works. So when we are doing those option trades, some of them I share with you here. When I do a trade with a 70% of probability, means I have a 70% chance that this will be successful. Does that mean this will be successful this month? No. But if I do this option, all 70% probabilistic chance of success, over time it will work out. That is why I want to increase my trade sequence. I want to make sure that I can reach to that 100 number, 101 number, 150, 200 number, rather than doing 4 trades or 3 trades in a year, each one separated 4 months, or 4 trades of, in a year, each doing 3 months apart. That's why I love doing every month portfolio. Time to start building June portfolio. Time to start building July portfolio. Right? Because that's how the probabilities will work out. So sequencing risk is 50-50 chance of tossing a coin. Doesn't mean that every alternate, wrong English, I guess. The right word is every alternate toss will be heads. First one needs to be head, second will tail, third is heads, fourth will tail. No, it doesn't work that way. So it means there could be instances wherein I end up into getting 5 heads together. So if I was betting on my money on tails, that's a sequence risk for me. 5 heads coming together, 10 heads coming together. Now, the idea is when we are doing this probabilistic based trades, how do we protect ourselves from this sequencing risk? You know, over a long time it will work out. How do we protect ourselves? Maybe the first few instances may not work out. Things that have worked for me, GDXJ had worked for almost every month, now for 15 months. Let's do 5 contracts on it. It's been working. But I don't know if I do 5 contracts, will I end up into sequencing risk now? I don't know. So how to avoid that is don't go all in single strike price. That is why when I do it, I'll tell you, this is a starter position. I don't know the next one where the stock could move against me. So I don't want to put all eggs at one strike price. I'll move along as the market moves. So if I've allocated $5,000 to do a trade on GDXJ or $6,000 to do a trade on GDXJ each, I won't do $6,000 on one trade. I'll put one trade at $2,000, wait for market to move, go against me, then put another one so that now I can buffer any sequencing risk. Again, if I put all 6, then I'm in a tough position to start managing. Oh, this is what I said, ladder those trades. If it doesn't go against me, great, we made money. Anyway, we made money. I don't get too greedy on, I should have put in all 6,000 here, would have made more money. No, we don't know when this market will go against us. So be aware of these sequencing risks and move your trades, ladder your trades. Oh, that's all about portfolio risk. Sorry if it was too heavy, but I thought we should talk about it today because it is important to understand. I've seen all these stories coming out when the hedge fund managers, they get blew up. We are all retail investors, but we can manage our portfolio way better than others because we are not answerable to anyone. So if we decide we don't have to take huge risks, we don't have to. If you're happy with the mediocrity, it's okay. We are not here to boast anyone that my hedge fund has the best returns for this year. Our focus and my focus is have a consistent return for longer duration. I don't want to be Archegos Capital, in the news on the positive side for a year and now gone out of business. So understand these risks, prepare yourself on how you want to mitigate it. And one big item in preparing yourself is investor mindset. So I'll come to option trades review later on. Let's jump onto the mindset. Let me ask you a question. Now, do you have a question for answer for this? What's your biggest investing mistake? So okay, if you don't want to share it with everyone, just send me a direct message. So I'll keep the name anonymous. But let me understand, what's your in your opinion, what was your biggest investing mistake? If you're okay to share with everyone, then you can just put it in the chat. Just want to see, how we see as a group, not selling to cut loss when I should. Okay. Anyone else? And what's your biggest investing success? Come on, I got only one response. Pay attention to order screen. I bought calls instead of selling. Not knowing horse well enough and buying 10 option contracts. FOMO. See, when the trades went against me, I lost a bunch. Uh, I would say that's a probably not you. I mean, markets could go against any time. That's market is not in our control. We will take what market has to give. Betting on hope has been biggest investing mistake. You're buying at peak value, that's a mistake. Unfortunately, we never know when the peak is until the stock goes down. So that's in hindsight, you will say, oh, that's a mistake. Hanging on too long on a losing position instead of accepting shares and selling calls. Okay. I had 10 contracts when I should have one. Got too big. All right. So my biggest investing mistake is I sold too soon. So the winner, I sold too soon. Um, some of those positions have become too big. So I'm like, why did I sell it when it went up? It doubled. Why did I sell it when it doubled? And nowadays, now that's why I have a tough time. People ask me in a chat. Today morning, they were chatting about someone on a crypto. It doubled in this week. I'm like, I'm focused on its business. It could go down 50% tomorrow. But I don't want to, I'm trying to learn, become better, not repeating the mistake of trying to sell what had worked. It doubled means it is working. The business is doing good. So my biggest investing mistake, I sold some of the winners too so early. Mercado Libre. I had bought it at 350, close to that, and sold it at around 580 within a year. Decent profit, you would say. Until you know that now it is trading at 1500. So, but good thing is I didn't sell all. I'm still holding on to some. I like their business. So that was my biggest mistake. What's the biggest investing success? What do you think is your biggest investing success? I'll start with mine. Then please put it in the chat. What's yours, do you think? So mine is how should I put it this way? Be aware and accept that I could be wrong in every trade that I make. And then trade accordingly. I used to do the other way around, in which when I'm trading in, I used to be, oh, I think this is how it will work. I think I've done all my study. It's great. When I'm saying it's in a short term, it could go very well against me. And when I started accepting that irrespective of my research, irrespective of my thesis, stock could go against me. That, I would say, as a trade is my biggest investing success. Now I am no longer, when I trade it, I'm always like, should go against me, so let's be prepared for it. I think that's what, when I think about risk before reward is, I think it could go against me. So now, how do I build and my portfolio and prepare for it? Prasad's biggest investing success, selling puts when the market is down. Yeah. Holding high return dividend stock and selling calls to increase income. So that you got now double dividend. Shannon, or if you're holding high dividend stock and you selling calls, you get double dividend on it. Selling puts and buyback calls when the market is down and reverse when the market is up. Again, these all are a manifestation. If you're selling put, is a manifestation of the fact that I'm giving myself room for error. So it's all great. So let's look at. So I told you earlier, I was listening through a podcast of whose was it? But it was about some exceptional traits of a great but little unconventional investors. First one was let your winners run. I think it was one of a Motley Fool's podcast. I have so many on my phone. Sometimes I forget which one was which. I like that. Not that I would do all of this, but want to share with you. If you want to pick some of these, up to you. So first great trait is let your winners run. I'll also explain in terms of I went back and looked at how my portfolio, how it applies to me. Some of the things made sense. Now, this is very different from what most of us as a retail investors do. Stock is up, stock has doubled. I like the business, but the stock has doubled, so I'm gonna, take my gains. Play with gamble. What say? Play with the house money. It's okay, nothing wrong in that. But many times people just cash out and say, "Oh, it has become double. Now I'll get in. I'll buy it at a dip." And some cases you may never get a dip. Even if you got a dip, and I'm talking about myself. I don't know about you, but even if I get a dip, that time I'll start to double question myself. I don't think that the stock will go higher because I think it'll go further down. I'll wait for a further dip, which may not occur. So first thing is great investor, let the winners run. Don't cut them off short. My first one biggest investing mistake was I cut Mercado Libre too early. Sold off some of them. It almost doubled. And if I held on to that, many other losses in other stocks would have been just, overshadowed by the gains in Mercado Libre. Which is other one, add up and not double down. I have a tough time in trying to follow this one. I'm trying, but it is difficult. Human psychology. If a stock goes higher, when do we actually try to buy the stock? When the stock actually falls down. I like a stock has now fallen down. I'm going to double up on it. Or if you like the stock because you love the business, fine. Many of the retail investors, we just see that the stock has been cut in half. I hold some, okay, let me reduce my cost basis. Let me add more. Reduce the cost basis, double down. What their study have found is this: we should focus on adding when the stock is winning. Put money on the winners. Generally, the great companies keeps on winning. So add when your business is winning. And it's a very tough way of investing. It's not easy, but we have to get into the practice of it. None of us would want to invest when the stock is all-time high. Actually, our first instinct is to sell when it is an all-time high. How many all-time high has Amazon made in its lifetime? Many. It's gone down. And again, it'll make another new all-time high. So again, it'll go down, again, it'll make another new all-time high. How many all-time highs did Bitcoin has made? So don't, we got to water our flowers and cut the weeds. Don't want to do the opposite way. Things that are not working, putting money on those. Put money on the ones which are working. I don't know. How many of you actually subscribe to any of these? I mean, do you think number one is, let me take a poll. Number one, do you think that's the right way? Again, everyone could have a different experiences on that one. I mean, I subscribe to this one because I had my own personal experience. You might have something different. So this is not a gospel. The finance management is a lot more about the person than anything about techniques. Do you think this let your winners run is a right way? Or we should just take our gains? The stock has gone up. Yeah, think about that. I'll go to the third one is be a dog walker and not a dog. What I mean by this is if I'm a dog walker, I know where I have to go. And I'm walking on a foot walk. So as an investor, if I'm investing, and that is why I generally say, I don't want to pick up any shares or etc. if I don't have at least 3-year horizon on it. Someone asked me, is it a good time to get in the stock? One of my friend asked me, I want to invest money in stock. I'm like, in stock market, 2022 was good. I'm like, fine. But put only money that you don't need it for next 3 years. If you don't have money, if you have money that you need it for next 3 years, then I'm not a right person to ask. I want to keep minimum outlook of 3 years. Have your time horizon. Because what happens within that, it's like I'm a dog walker. I know my destination. Business is marching towards it on a foot walk. What a dog does when the dog walker is walking it, dog goes like this. As a dog walker, I'm not going to chase every stock movement. As long as I know that it's moving in the direction where I want it to go, business is going in that direction. And my outlook is not that I'm looking for the next 3 steps. 3 steps, dog could be anywhere. But I need to reach that destination. And if I focus on that, it's okay. Dog could be on any place, but over a period of time, we'll be at our destination. So have your time horizon. Otherwise, we'll be just moving in and out of a stock and wondering that the markets are, are not for retail investors. I think it's a lot more on to us. We don't give enough time for markets to play out. My minimum time horizon is 3 years. I don't put any money on the market which I need for next 3 years. So if markets are closed tomorrow, will it hurt? Yeah. But we'll have food on the table. So that's number 3. Let me read some comments. Prasad says, I'm also getting down without taking a lot of gains. It means you didn't have winners, which is the opposite of. Carmen says, I always miss the run-ups and want to get better at not taking profits too early. I was in the same boat, and I think it's a challenge. It's a challenge. And this challenge becomes even more intense if we don't know about the business. If I've invested in a stock because my friend has invested in it, then I'm the first one to take it out when the stock is doubled because I have no conviction on it. I don't have any conviction of my own. So if you're investing based on tips, or if you're investing based on what you hear from your friends or in some online forums, those are the positions which I'll exit immediately if the just stock goes high. So it's better to have your conviction on the stocks, to your study on the stocks. Steve said, let the winners run, but don't get greedy. Pigs get fed, hogs get slaughtered. Yes, don't get greedy. It means, if the business is doing great, and I don't need money, I don't have to slaughter. The issue is on the, I would say issue is the focus on the business side. Will the stock could fall down another 20%? Yeah. But if the business is great, it will probably eventually again go over there or probably go higher than the previous all-time high. List question, great. When do you sell? I sell only if I need money. So for example, Mercado Libre I sold. I didn't need money. I already had cash in my account. I sold just because stock is double. If I need money, there are reasons on sell. If I need money, if I need to buy a house, I'll sell. In that case, I'll sell my winners or losers. If I do need to have funds for my kids' education, or if I'm to plan for a vacation, these are the plan anyway we should have planned for and have the money separately. But in case, so you sell when you need money to use, not because the stock has gone high. There's a difference. If you have your winners, your stock has gone high, then there is no need to sell if you don't need that money. But your 3 months of winning could fall back down when you bought it, of course. But then again, I'm not looking at next 3 months. That's what. If your time horizon in 3 months, I think then the stock market is not really a good way to be in this. And coming from someone who actually trade options at monthly level, but my time horizon is still 3 years out. The stocks that I trade options on, if I get those assigned, my outlook is I'm going to hold them for next 3 years and I still trade options around it. Does that mean if it had fallen down and cut into half, it's okay? It's okay. I don't need that right now. Anyway, in 3 years, if the business continue to perform, it'll make it not only reach that high, it'll go further higher. There are many stories of people who sold off Amazon at $500, $600, or Apple's. And now we know options. If it goes against us, we can still continue to reduce our cost basis. So using options are not become better on buying and hold. But when do I sell it? When I need money, not where that the stock has moved. Isn't it best to take a little off the table as it is going up? It's not wrong. I'm not saying it's bad. It's not wrong to take a little off. In the end of the day, if it is causing you to lose sleep, that, oh, my stock has now become 4x, I should take some gains, otherwise what will go down tomorrow? Sell off. There is no investment is worth losing sleep. But if you sell off everything and the stock doubles later on, if you have that repent, I sometimes have that. Most of my repents are not the losers that I held on to, but the great companies that I sold earlier. So we'll go, I think later on we'll see after this in terms of what actually constitute the winners in your portfolio. This one we already talked about, stay small. So not gonna go into that again. The last one is investing is like a venture capital. 30 to 40% of our investment or the stocks that I picked up will go bust. Let's understand that. Let's not take it against my intellect that, oh, come on, how can I have a 40% which will go bust? This is how the markets will behave. Less than 5% will be the huge winners. And that may, or I'd say 15 or 20 to 25% of your stocks will cover all the losses from those 30 to 40%. It always happen that way. In the markets, stocks that give us extraordinary gains are not too many of them. There are few of them. And the problem with us as a retail investors is we have those few of them, we see them doubling or 3 times, and then we sell them. If we held on to those few of them, they will take care of those 30 to 40% which have gone bust. I have some of those in my portfolio. Not every stock that I invest in is a winner. I'd be lying if I was saying, I've got that golden touch. No. But I'm very much focused on trying to figure out when should I not sell. My regret is I sell too soon. Some good businesses. So if I understand that 30 to 40% will go bust, I feel better than it's not against me. This is how the market, it is like a venture capital. You do your best stuff. Companies always will not perform. So now using options, I don't have to really sell it too soon. And if I've sized my portfolio well, if something's fall off 50%, it's a well-diversified portfolio, sized it well, I don't have to lose sleep on it. So I think I found these very interesting. Thought I'll share in today's session, which is mindset. Today, all we talked about is how to become a better investor and protect our portfolio. Sorry, didn't go into any stocks today. Didn't talk about what all these companies are doing or what I'm seeing on Twitter. Today's session was dedicated to being better investor, and more, at least I'm realizing as I continue to stay active in market is a lot more about emotional quotient than intelligence quotient. A lot more about EQ than an IQ to be successful in markets. For example, I'll spend a lot of time in analyzing a company to study, look at a business, great. But if I don't have that emotional wherewithal to hold the stock or to not give in to FOMO, it's not going to work. So IQ related things we can find from many places. You come in this session, I talk about a stock, I do a deep dive in that stock. So that's an IQ. You're getting that from me. But how you then perform, how long you hold, how you open up your positions, all that is based on your EQ. How do you feel if the stock has gone down 25%? Even though you know that there is no change in business, all that is EQ. And more I realize is this area of EQ where I have not focused earlier, it is actually becoming way more important than IQ. IQ I can find from a lot of places. There are many services which will give you stock analysis. And I subscribe to some of that. But I have to focus on EQ to become a better investor. So that's my take for today. Now we are only left with option trade reviews. So any questions? Did you like it, this mindset? I know this is a little unusual. Topic we picked up for today is to go through mindset sessions. Okay, let's, any feedback? Helpful? Change of pace. Okay. All right, so let's interesting. I mean, some of these things when I realize, I'm like, you don't need a finance degree or have to go to Harvard or to learn all these things, which actually are way more important in becoming a long-time better investor than trying to figure out the MACD or CCI or Bollinger Bands. Prasad, you've been too generous, Prasad. I am trying to learn. And learning is always better when you are doing it as a community. So For years, I was not investing in, I was a little scared, to be very frank. I was scared because I don't know where the market will go. I didn't have time to look at the markets. So I stayed away. But now I'm becoming focused. All right, so let's look at the option trades. Will be done in 5-10 minutes. So this is where we were. Oops, the whole no. Huh? Hold on. I'd copied pasted that mindset in between. Looks like, yeah. No, it's all correct. So last week we had these two open trades, XLY and Microsoft. Out of these, we not completely closed, we kind of rolled. If you look at a Microsoft, I rolled out Microsoft because tech was weak. I had a short put in Microsoft. Stock went down below my strike price of 250. 21st May is coming soon. So stock price was at 241. I rolled it out from May to June. So when you roll out, you close the current position, open a new position. So when you close the current position, this current option position, what is lost? So we took a loss of 750. It's a temporary loss. I'm still bullish on Microsoft. I want to hold it on Microsoft. When we roll it out, we got additional premium of more than around $2.75. And stock, if stays above 250 in June, will recover all this loss. But temporary, it is a loss, so it is here. So we closed down that Microsoft and opened another one for June, which is this one. So we did it on 12th, rolling the short put on Microsoft from May to June. There's a weakness, so that the trade got punished, and we don't know where the stock will go. Microsoft is a great company, long term. Short term, stock could go anywhere. I like to get more time on this, so rolling it out for a decent credit. Next, I bought a put. I don't know how long the weakness could consider, so converting the short put into a put spread. Now I know even if the stock market continues to stay weak, inflation continues to run high, our total risk is now limited to $5,000. So 250 short put, 200 long put. That makes my put spread. Maximum is risk is $5,000 in this, and the premium collected is $439. So my cost basis now is 250 minus 439, which is 245 and 61 cents. $2.45, $245.61, which is Microsoft is already above that, but we'll hold on to it unless, including the previous loss, the overall trade becomes profitable. So that's what on Microsoft. Let me just pull that up. Yeah, I should have done that. So where we are right now is, that's the put spread. Oh, if you look at it in your Thinkorswim platform, it shows me that I'm making 485 right now. But remember, I took a loss of 750. So I'll hold on to this until it's making at least 750, overall. So that's where on Microsoft, holding on to it. The other one was XLY, which is still open. Let's look at XLY. This was this was an iron condor. Oh, okay. Maximum I can make in this 193. We just put a trade and did nothing on it. And hopefully, I mean, it's still way within our break even. Break even is 163 all the way to 186. We'll close it when it's making around $110, $120. defined risk trade, not a big issue. I know exactly how much we're gonna lose in case if it goes against us. So yeah, that's it. The new trade was on the Microsoft year to date. In this meeting, we talked about 42 trades till now, completely closed 39 trades. These are the 3 which are still open. 7 are the losing trades. Today, Microsoft added 1 count to it, to that losing trade. And yeah, net proceeds are still positive, which is great. Love those positive number. So I guess that's it. Quick update for those who joined later. On the crypto, we actually meeting on Thursdays. So I talked about the backbone of crypto, which is blockchain. We delved a little bit into the blockchain, how it works. And then, of course, we talked about the general, what I'm seeing in this crypto world in this week. The section that I used to cover in this meeting, now I moved over to our Thursday meeting. So we'll have the next one on 20th. But before that, on Tuesday, our next section on bootcamp is building a diversified portfolio using options. So today we talked about we should have a diversified portfolio. Now I'll take an example of, let's say, $50,000 account. And we build a diversified portfolio using options on Tuesday. That's it. That's all for today. If you have any questions, any specific to stock, let me know. If I am following that stock, I'll share what I can. If I'm not following it, I'll take a note of it. And maybe we'll give you some analysis next week. Otherwise, I'm done for today. Welcome, Dave. Welcome, Ramesh. Cool. You're welcome, Abe. Oh, welcome, Alec. I see a question. Did you roll out Baidu short put? Not yet, because Baidu is about to report earnings. So I'm holding to wait and see what it does on earnings. After that, I'll roll it out. So I'm still holding. I think its earnings is coming up in the next week. So because of that, I'm still holding. Otherwise, if it is no earnings coming up, I would have rolled Baidu by now.